Hello, welcome to Soundbites, Fidelity's monthly podcast where we talk about all things investments, and welcome to 2024. Hopefully everyone's had a relaxing break and feeling rejuvenated. And I'm pleased to be joined here by our illustrious equities team, Aussie equities team. To my left here, I've got Paul Taylor. Across from me, I've got James Abella and Casey McLean. Thank you, gents, for joining the podcast this month.
Good to be here.
Thank you.
And so this month will be really focused on what the year ahead might bring us, so a bit of an outlook. But before we get to the investment piece, I guess any bold predictions for this year could be anything, whether it's sporting, any bold predictions, and what we'll do at the 12-month point at the end of the year, we'll reflect on those and see whether any of them came true. But maybe I'll start with you, Paul.
Yeah, well, Broncos will definitely win this the NRL Grand Final. We had a disappointing end to 2023, so I think 2024 is going to be much better for the Broncos. Brisbane Lions probably also, I think, will go one better in 2024. And the women's Brisbane Lions will just stay on the top. So, yeah, we'll one stay at the top and two will get from second to top. Yeah.
So there's a common theme there, something to do with Queensland, I think.
These are the easiest predictions I've ever made.
Casey?
Well, on the sporting lines, I'm pretty sure New South Wales will win the State of Origin. But broader than that, I think it's going to be a year of surprises in elections. There's about 40% of the global population has an election this year, and I wouldn't expect all of them to go with the odds. So expect some surprises there.
Absolutely. And James?
I think inflation's probably the big one. It's on everyone's head right now, and the US and the UK have come down towards 3%, and can Australia do the same is the thing. So that for me, I mean, if we are following the UK and the US and we're 6 months behind, inflation should be below 3% in Australia within the next 6 months.
Wow,
that will be a surprise. But yeah, that's probably a prediction that I think is an interesting one.
Okay, so we've got a mixed bag of predictions there. Basically, Queensland's going to dominate everything.
Except State of Origin.
Except State of Origin and inflation. What we might kick off with is if we reflect on last year and sort of thinking ahead. Last year very much was a market focused on by macro, big thematics. James, you mentioned inflation. If we head into the next sort of 12 months, do you think those big macro factors will continue to play as big a role as they did last year, or are we maybe heading into a different environment for 2024?
Yeah, well, I do. Yeah, so my prediction is to move into a different environment. I think it will be about bottom-up stock selection. I just think as some of those variables start to stabilise, I think people will move away from trying to predict, as interest rates going up and actually focus down on the company. And that's, in the long run, that's what drives value. That's what drives wealth creation. It's, is that company going to sell more products? What's their strategy like? How are they rolling out around Australia, around the world? People will focus back on bottom-up issues that are very company specific, because if you get some stability in those macro factors, I think that's just where where attention moves. And I can definitely see that. I think there will be a change of approach in in 2024, and it'll be all about the bottom up.
The bottom up, yeah. Casey?
Yeah, I think the headlines are sort of writing themselves already. That 2023 was a year of interest rate rises, 2024 of interest rate declines. But what that means for markets is still uncertain, because about half the time when we're in an interest rate cutting environment, market goes up, the other half goes down. The key differentiator really is whether we're in a recession or not. And if we look at the predictions at the moment, the median of economists, it's 50% in the US and 40% for Australia. So hopefully those predictions, the probabilities come down and the markets rally, And I think the best sort of environment is more of a less directionless market like we saw in 2023 and more trending sort of market where we can go down and find the best stocks that outperform in those environments.
And James, your perspective, because obviously you cover Aussie and global equities.
Yes.
Any other sort of observations?
So, at the moment, the US market has really been leading the world back into recovery, but then unemployment was, a bit different. So the economics is still a bit uncertain, but the big thing is definitely the bond market, and refinancing risk in small caps is definitely globally and domestically still a significant focus. So if the bond markets, can lead us into better times and have less risk, then probably the recovery will continue on. Will the cyclical recovery continue? The last few months has been industrials, financials, consumer, tech has all been pretty positive, its earnings, but it definitely will be more bottom up, as Paul mentioned. So therefore what you do is, you move to duration, and that means you can move out in valuation dispersion, and that's probably what 2024 is likely to be. If the bottom up is fine and we don't have the recession or the slowdown, as Casey's referenced, bond markets are positive, then I think durations and valuations start to expand, and that'll all come together in 24.
So very much seems like it's potentially going to be much more of a company-specific, bottom-up driven market than what we maybe had last year. If we think about the year ahead, I mean, every year brings us sort of the unexpected things that we don't really anticipate. Last year, obviously, there were geopolitical tensions. We had the conflict in the Middle East kick off, and so forth. So there's always that sort of X factor. If you sort of think about the year ahead, and I know, Casey, you've sort of alluded a little bit in terms of, there's a lot of elections happening. Notably the US, whether we do or don't see Trump maybe get back into power. I mean, all of these things obviously can have an impact. What are some of the things that, in your mind, the key things to look out for in 2024?
Yeah, well, I think, elections is definitely going to be a big one. US is one, and if Trump comes in, he's said he's going to tear up the IRA, which would have big impacts on the whole electric vehicle value chain, if that does happen, and really shift the landscape there quite a bit. I think Taiwan elections probably a smaller economy, but just as critical for the whole geopolitical tensions around the world. That takes place this year as well, and India, the world's biggest democracy there, they've got one as well. So they're going to be interesting, and I don't think it's all going to go to script, but I think one thing that we have to be sort of wary of is that the consumer and businesses have been really resilient over the course of 22 and 23, given they build up lots of cash reserves, cash buffers from fiscal handouts. They locked in low interest rates with 30-year mortgages in the US and extended their debt with the corporates. But a lot of these defences are weakening. They've run through a lot of those excess savings. A lot of companies are reaching bond maturities, need to refinance at higher rates. So, it mightn't be a recession, but there could be an impact on growth and a long elongated period of slower growth and slower consumption as well. But I think that's one area of potential negativity. But at the same time, there's some cyclical type companies and sectors that have been in a downturn for a long time. They've had their recession. Their earnings are at trough, and they look much more attractive than some other segments.
James, from yourself?
It's I don't know. It's just a hard one. Whether the trends can continue is really just the key question. So the industrials probably strength has just been a real surprise. So Seven, Boral, CSR, all of these had really strong results, really strong AGM updates. And that just signals you wouldn't expect them to have pricing power. But I do think during the year it's going to go back to these fundamental things of pricing power and the market structures of businesses, because they're the things that valuation dispersion is kind of extending, but whether that can continue on and market structures will allow you to continue on to push through prices. So I think competition will probably rear its ugly head in 2024 a bit more, because it hasn't been very competitive in 23 because it's been very patchy. But I do think if the economy does strengthen, then competition will probably start to contain that enthusiasm for just margin expansion and recovery and everything's kind of good environment. So that's what, something I'll be looking out for definitely in 24.
Just interested to explore a little bit the concept, the notion of recession, because, from a global perspective, probably Fidelity has a 60% probability on what we call a cyclical recession, about 20% soft landing type of scenario. If we do head into potentially let's call it a cyclical recession, what does it actually mean for markets? What does that type of environment mean for markets and stocks?
Well, obviously a recession is not good for stocks, although the market does look ahead of the economy. So if you go into it and the market's already expecting it, actually once you go into a recession, actually it could be a reversal. So it sort of depends. So there's a couple of different factors. Well, what's priced in? People expecting. So if we're not expecting a cyclical recession, you get a cyclical recession, it'll be negative. If we are expecting a cyclical recession, and it's probably already priced in, are we expecting a deep cyclical recession or just a very shallow recession? And I would also put, I guess the point to bring out on that is also Australia relative to the rest of the world. Yeah. So in that probability is maybe referring to the sort of bigger markets of the US and Europe, and maybe less so Australia. I think our base case is still very much not a recession in Australia. But yeah, so to me it's all about expectations going into that as well. Where does it come out relative to those expectations?
Casey, James, anything to add?
Yeah, well, I just think regardless of whether we do have this cyclical recession or soft landing or not, what I think is definitely off the table is a deep sort of balance sheet type recession that we saw in the GFC. Yeah, households in general around the world are in pretty good shape. Corporate balance sheets, financial companies' balance sheets, they're all in good shape. There's no distress there. So if it is a cyclical recession, I think it's relatively shallow compared to previous cycles. And it does, like Paul says, come down to expectations and where we're priced at that point and how the market reacts to that. But it should be a relatively benign compared to some other cycles.
So when you sort of, I guess, because you've got the luxury of actually meeting a lot of the companies, meeting the on the ground sort of operations, and so you're really close to the market. And from that perspective, are any of you sort of feeling that across the companies that you cover that from a management perspective they're sensing a recession or not? Because that bottom up is really the thing that will drive the market.
Yeah, not in my world. The ones that have been really affected have been the ones that are labour constrained and cost constrained. They've had very big downgrades. So things like healthcare services and industrial services, where they're very labour intensive, they've had very poor profit warnings. It's been a very, very difficult environment. But that's a small portion of the market. But overall, things are kind of still okay. Like we mentioned, it's still been okay. And for the portfolio, it's how much you want to expose yourself to the beta or the recovery. If it's going to be a shallow recession and valuations are attractive, then you do go through to consumer financials, tech and industrials. But if it is a recession or it is a smaller slowdown, then maybe you want to go through to something like staples or through real estate. And the last little while, real estate has kind of taken on the positive market sentiment shift, and it's actually rallied pretty well because it is affected by capex, it's affected by labour, it's affected by cost of capital, and it's affected by discount rates and valuations. So if you do have peak rates, peak inflation, all of those become less bad for real estate, and a lot of them are trading at 0.75 to 0.8 times book or NTA. So that kind of may be more interesting than if we are in a different kind of environment. But I think it's a matter of how much you want to, I guess, expose yourself to the beta and the recovery if the recession isn't, as Casey mentioned, as deep as you think or is expected.
Yeah.
I'd also just add, I think, sort of differentiate the risks based on goods versus services as well. And I think goods, exposed companies have probably already seen their recession. You look at Germany, very much a goods exposed company with their huge auto market, export markets, and they've had PMIs in the 30s, which is signals a deep recession, right? But now they're probably most of the way through that. China is getting less bad. It's still not good, but getting less bad in their macro sort of conditions as well. Whereas service-exposed companies have been doing much better. That's Australia, the US as well. And that, potentially they see a slowdown, but still be more resilient, and goods-type exposed companies can recover.
Yeah.
Yeah, I'd also say, look, I'm probably, when we meet with companies, I'm probably focused on a slightly different factor. So I'm not sure I mean, some are better than others, but I don't know whether companies themselves are good at predicting demand. I mean, they'll see it when it happens, but they're not. They're like everybody else. We're fearful or excited, and I just don't think I don't necessarily put a lot of stock when I talk to the management team. And our approach is waterfront coverage. We're meeting with the pretty much the entire market every quarter and updating our earnings, cash flow, valuation model, balance sheet model every quarter. So it's an important part of it, but I don't know whether the companies themselves always see that. I guess where I'm more focused is sort of what their intentions are. And I think that's always the interesting thing. So companies will have, as conditions stabilise and they get a little bit more certainty, they'll have a better assessment of projects, so they'll start doing things. So what I'm normally trying to get at them is what their intentions are. What is their CapEx? What are they going to be doing? How are they going to be expanding? I think a really interesting topic in 24 is also going to be things like artificial intelligence. How are companies integrating artificial intelligence in their process? That's a really interesting. Now, that's not going to tell you, what their demand is, but it's telling you about their cost base. It's telling you about how they're meeting the market. It's telling you about their strategy, how good the management team is as well. Automation on some of their production. So, when I talk to the company, they're the things I'm always interested in, because I don't know whether they have a really good read on predicting what's going to happen over the next year. But they obviously do have a very good read on what they're going to do. Yeah. CapEx, artificial intelligence, automation projects.
Great. We might sort of get a bit of predictions, bit of sort of, I guess, views on the next 12 months from a stock perspective. And I guess what I'd be interesting to explore is, maybe one or two stocks that you're most excited about for the next coming 12 months and why.
Yeah, so for me, it is, so like I said, it is very much focused back on individual stock selection. I think, that will be, that will be an exciting prospect. I'd also be very focused on the broadening of the market. So if you go back to 2023, it was a very narrow market. We talk about the Magnificent Seven. There was a few stocks that really, technology was the best performer in 2023 as well. So look, to me, first of all, I think there will be a much more broadening as things stabilise, but very much on individual, an individual rollout as well. Some of the companies that are the biggest in the portfolio for me anyway are companies like Seek, which I think has a great long term. So once again, these are not, when I look at these companies, I'm not thinking about 2024. I'm actually thinking about the next 5 to 7 years, right? So that just to put it in that context. So I think Seek has a fantastic model. They dominate the recruitment space. I think learning will be an important, their sort of online learning will be an important part of it as well, a way to train people, because I think you think about the big thematics, probably as I was growing up, a lot of people were still in a job for life. Now I think the young ones realise that industry is going to get disrupted. People will change jobs multiple times. So all of a sudden, if you've gone from a job for life to now 10 jobs, that's they've just multiplied their revenue by 10 times, and you have to get retrained each time. So to me, there's a few different questions that come out of that, which is So how does that change education for a start? So you get, does that, you might go to university or whatever training you do, which is more general, and then you have to retrain as industries get disrupted and you move from industry and you move jobs. There's a whole lot of, and so you think about that from a sort of adult ongoing education, that there's going to be an interesting dynamic, and just the rotation of jobs will be important as well. So to me, it's those sort of, but like I said, I'm not focused on them for 2024. I'm focused on them for the next
Longer
5
term.
to 7 years on some of those bigger trends. I talked about artificial intelligence. I think that's going to be really important in sites like Seek as well.
Casey?
Yeah, I'd also preface my stock selection here with that same longer term view that Paul has as well. But one stock I think it can do well both longer term and potentially in the near term as well is SiteMinder. Who do software for hotels, channel management software, which allows smaller hotels, mum and dad type hotels, to plug into the 400 plus online travel agents, the Bookings, Expedias of the world. And it's really about efficiency for them. Firstly, this is taking away from a manual process of pricing rooms, managing inventory that they do in Excel. But it also means that they can have better pricing. They can see what's going on in the market and maximise their revenue. And if you think travel has had a great period, revenge travel coming out of COVID, and if that slows down, the emphasis is going to be on cutting costs and maximising revenue. So in the short term, it could be well supported as well. And they're adding a lot of hotels in what's a really quite lowly penetrated industry at this point. But longer term as well, I think they have really good prospects. Firstly, that penetration is going to grow, but secondly, their ability to monetize is increasing. They've got such a wealth of data, some of the best data in the travel industry or the hotel industry, that they can use to do AI, predictive pricing. Based if you got state of origin, for instance, and the demand around Homebush is going to increase on these periods, that you should price up accordingly. And they're changing their model slightly to be, taking a very small cut of the revenue that the hotels make out of their system as well. So it's a company it's loss making currently, is should and on their guidance reach break even. So I think they've got quite a good long term and short term runway.
And James, from yourself?
Yeah, I'll stick with one that I've had for many years. Over the decade of the fund, I've held it for a long period of time, which is Altium, ALU. It's in that Internet of Things and artificial intelligence environment. It's the software that designs PCB boards. It'll be in everything. It touches so many different things that we have in the world in terms of technology, and it'll be around for many, many years. It's been a huge success story for 10, 20 years. It has great financials, a very high return profile, very high cash flow, had 15, 20% growth for the last, many years, and the next future years expected. The market structure that it's in is very tight. There's only 3 or 4 players in the world that actually does what it does. It got there was a takeover offer from Autodesk towards Altium in the last couple of years. The CEO mentioned he spoke to Google as a takeover 10 years ago. It is in a great space, and it provides a great service for the world. To design a PCB board with multiple countries, multiple engineers for a product that might be made in a different country, but a chip's designed all around the world. So Altium's, for me, probably the most exciting and interesting one that I've had for many years, and will have hopefully for many years as well.
Fantastic. So we might sort of leave it there, but I think what I really got out of this conversation was a couple of things. And one is that we maybe, 2024 maybe will be an environment where macro dominates less, where we're possibly back into a really bottom-up stock-specific market environment, which is really exciting for active
Stock
managers
pickers,
such as Fidelity. And I guess some of the other things is the breadth of the market again. And if we sort of cast our minds back to 2023, there were very narrow parts of the market that did well. And the more breadth of the market in terms of what could do well, again, is a real interesting opportunity for long-term investors. So thank you very much. I think that was a great discussion in terms of what the year ahead may bring, and we'll definitely keep an eye out on the Broncos to see if they do win the premiership. So thank you, gents, and thank you for joining us. And for the listeners out there, thank you for taking the time. If you like what you hear, please hit subscribe on whichever podcast platform you are using. And if you would like to get any more information regarding Fidelity, please have a look at our website, www.fidelity.com.au.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.